And there it is. You know what that sound means at this point in the day. The closing bell of the New York Stock Exchange, wrapping up a day of trading there on Wall Street. There we go. The hammer is hit. Let's take a look at the big board. You can see it was a relatively strong day for the Dow Jones until the Federal Reserve announced they're hiking interest rates half a percentage point. You see stocks ended down more than, 140 points.
Yeah, the S&P 500 and NASDAQ are also each down roughly 0.5%. And now we are excited to dig into all of this with host of TheStreet, J.D. Durkin, who was on our air earlier today. Well, we watched live at 2 o'clock as Fed Chairman Jerome Powell was announcing that 50 basis points was going to be the next interest rate hike. We saw the markets then really sort of plummet after that, rally for a second and then back down into the red. What was going on?
Well, we talked earlier today about the fact that investors would try and sense which way this goes on Fed days. And happy Fed Day, by the way. We celebrated down at the stock exchange.
Is it celebrated?
Oh, yeah, of course.
All
I mean,
right.
it's a big deal. It's the number one story in the business world. We often have a day like this where we seesaw, we go back and forth. We talked this morning about the idea. We came into today's session to say, if it's 50 basis points, that's more dovish, perhaps more of a positive outlook for investors. But what Fed Chair Jay Powell made clear is to say that terminal rate is going to be higher than we thought next year. And you look at what's called the dot plot of all the federal governors, and they say it's going to be probably north of 5%, and it's going to stay at that level throughout 2023. So even though the short-term news today could be perceived as being very positive for investor sentiment, there might be some worrying signs about just how high those rates will stay through next year into 2024.
They really pay attention to every word out of Jerome Powell's mouth.
That's exactly right. And to your point, you said it may be more important not how high the rate goes instead of how fast it raises these things. Let's just quickly listen to what Chairman Powell had to say when asked about if a soft landing with this recession and inflation is possible.
No, I wouldn't say that. No, I don't say that. I mean, I would say this, you know, to the extent we need to keep rates higher and keep them there for longer and inflation, you know, moves up higher and higher, I think that narrows the runway. But lower inflation readings, if they persist in time, could certainly make it more possible. So I don't think anyone knows whether we're going to have a recession or not.
Okay, pretty honest there. And as you mentioned earlier, you get more out of Powell during that Q&A than his highly scripted remarks. So what do you make of that response to the question?
It's also kind of funny. He says, well, no one knows that there's going to be a recession. I think most Americans will say, well, if there's anyone who does know, Mr. Powell, respectfully, sir, it is probably you, and you are telling us that we don't. Of course, you look at these business CEOs, these surveys from CEOs around the world, and they say nearly unequivocally, if we won't be in a recession next year, it's because we're already there. And it's amazing. I think when you look at the Fed governors, there's about 19 of them that vote. There's this anonymous survey. We alluded to it there a moment ago. And they say this rate is now likely to be north of 5%. That was far higher than in September. And if you look at the reaction out of the stock market on previous Fed days in September and again last month, as Chairman Powell gave us more information, stocks began to tumble. I think because the emphasis coming in today was hope for more of a dovish sentiment that would be more positive, they start to look at that long-term prospect and say that's really going to hammer a lot of the popular stocks and companies that investors have gotten used to investing in during this long-running era of what we call easy money when interest rates have been at or near zero.
So, J.D., when you look back at the year that we had and what the Fed did, 7 interest rate hikes, the last one finally bringing us down a little bit from their rate, how would you characterize the job that they did?
The job that the Federal Reserve did?
Yeah.
Yeah, I mean, listen, well, if you ask business CEOs, and they've been pretty unequivocal for the most part to say these rate hikes need to stop yesterday and we need to start bringing this back down to earth. But not all of them. Even Jamie Dimon of J.P. Morgan Chase has been clear to say, you know, inflation is likely so stubborn, interest rates should stay higher for quite some time. He points to the crisis in Europe, just says this is the largest land war in Europe since 1945. And that might not be an element that is really taken into consideration by a lot of investors here. So it's the most unenviable job in Washington, D.C., I'm sure. We joke down at Wall Street and at the stock exchange that most people think the president is the most important person in the world. But on a day like today, it might very well be the chairman of the Federal Reserve. This is not an easy job, but but it has not been an easy job for previous Fed chairmen before him. It's a very difficult tightrope to walk.
And as you mentioned there's a limit to what any one person or institution can do when it comes to the inflation and recession. When you talk about global events, China, the war, COVID, etc. So the bottom line for us then, we know it's been a rough 6 months. What's the outlook for 2023? Do our viewers have any reason to believe that some relief is in sight on the next calendar they're purchasing for next year?
Well, honestly, I think it depends on what sort of relief you're looking for. If you're looking for a job right now, the job market remains very hot. If you're a job seeker, it's very positive. But if you're looking forward to some of these big ticket purchases that you had hoped to put your money towards, those things are more expensive and more people will begin to tighten their belts. I usually like to take my gauge from a lot of business CEOs, especially who represent companies that are going public, and they say, we are really in for rough territory. I think we've spoken the last time I was on with you a few weeks ago that even Jeff Bezos of Amazon, right? He runs the world's largest e-commerce giant. And he says now is probably not the best time to go out in pursuit of that flashy flat screen TV that you want. Batten down the hatches tends to be the overwhelming sentiment from CEOs. And I think that's important for day-to-day Americans to keep in mind.
That's interesting, too, because not having reserves is part of the story, and we should get into that again with you sometime.
Absolutely.
Great to have you here in studio.
Great to join you. What a beautiful set. Great to see you both.
Come back anytime.